All right, here we go. So thank you for joining me for my How to Buy Masterclass. This is both being recorded live for the people who are on Zoom, also streamed into social media. So if you're watching this live, feel free to post comments into the chat where you're watching, or if you're on Zoom, post comments into the Zoom chat. And if you are watching recorded, feel free to ask any questions down the road, and I will be here to help answer those questions and get back to you on anything that you need help with. So let's go ahead and dive in and get started. The first question I always like to bring up is now a good time to buy a home? And I got to tell you, that is a very, very difficult question to ask. And it really mostly has to do with, are you able to afford the payments that comes at the high interest rates of today? So every single month I address this question. Every single month it's a little bit different because right now we've seen interest rates go up. We're recording this on May 25th. We are 7 days away from when the federal government is supposed to hit the debt ceiling and run out of money. And there's a lot of volatility right now. We're seeing interest rates now getting closer to 7% or above, when just 2 or 3 weeks ago we were down at around 6%. So we're seeing huge swings up and huge swings down. Clearly, you can afford more when the rate is 6% than when it's at 7%. You can also afford more when the rate was back at 3% 2 years ago. And so the question becomes, what does the rate mean to the price of the home? And as you're shopping for homes, you're going to see volatility like we're seeing right now. We've pretty much been in a range from 5.75 to 7.25. So we're currently touching the highest end of that interest rate range. And so when you ask the question, is now a good time to buy a home? Well, here's the deal. Big picture, house prices have come down some in the last year simply because interest rates have gone up and buyers like you have a harder time affording the payment for that particular home. And so the prices have had to come down a little bit, but for the most part, they've stopped coming down, especially at the low end of the price range within any particular market. We're kind of seeing at the high end of the price range, the mid to high end, that we're seeing a lot more availability of homes, maybe sellers giving some concessions still. At the highest end, like the cream of the crop homes, we're not seeing sellers give anything. We're seeing those homes move super quick at the high end. We're seeing homes at the low end move super quick. It's at the moderate to high end that you're seeing houses still having a little bit of negotiation power on the buyer's side, but that's quickly changing. Why? Because there's more and more buyers who are getting tired of renting and saying, you know what? I get it. Rates are going to stay around 6 or 7% for now. I might as well buy. And one of the messages I've said for a long time is, hey, we fully expect, and nobody can guarantee, but we fully expect that this is really the high end of where we're going to see rates because of inflation, and that we're going to see interest rates come back down. When we see those interest rates come back down, if you bought a home now, you can refinance. But if you wait until then to buy a home, you're going to get a better interest rate, but you're likely to pay more for the home, because you're going to have a lot more competition with different buyers who are trying to compete with you now that interest rates have come down. So the biggest question being, what do you see out there in the market and the price range of homes that you're looking for? And if you are comfortable making the monthly payment that is required for that home, then I think now is an amazing time to buy a home. If you're not comfortable making the payment, if it is too much of a stretch for you to make that monthly payment, don't kill yourself. The worst thing you can do is get into buying a home saying, okay, I'm going to buy and get a temporary buy down. By the way, I like temporary buy downs, but only if you can afford. Carol, I appreciate that. And I will look into that. So only if you can afford to, only if you get, so anyway, sorry, I got distracted by that. Temporary buy downs are only good if you can afford what the long-term rate and payment is going to be. So a temporary buy down is a really awesome option that allows you to get a lower payment for the next 1, 2, or 3 years. And so if rates right now we're at 7, you can get an interest rate of 6 or 5 or even 4% for the next 1 or 2 or 3 years. But it's going to go back to 7 at the end of that temporary time frame. And you have to get help from the seller to pay for that temporary buy down. And so it ends up really being a position where, hey, it can definitely make it more affordable to own a home in the short term. But if you can't stomach that long-term payment, doing a temporary buy down, all it does is set you up for failure. And that is the last thing that I want to have happen is failure. So make sure you can afford the payment. Now, there's a stretch that's necessary for a lot of people. So I'm not telling you don't stretch. I'm not telling you that, hey, only buy a house if the payment is comfortable. Unfortunately, those days are long gone. And I'm not sure if and when they're coming back. House payments get lower over time. Rent gets higher over time. And so to become a homeowner, you've got to step up what your monthly payment is compared to rent. But over time, your house payment's going to go down and your rent's going to go up. And you'll be glad that you took the leap to become a homeowner. All right. So really, my thought right now is simply, if you can afford the payment, you still have less competition today for the homes that are on the market compared with what the competition is going to look like when interest rates come back down. And the simplest way to finish out this topic is to give you kind of a visual. So if you were to think about a college football game where the college team, the home team won the championship, well, everybody who is in the stands rushes out of the stands and rushes onto the field to celebrate. Well, that's kind of like what happened in 2020 and 2021, is you had a whole bunch of people who were thinking about buying homes and rates dropped significantly, and everybody who was thinking about it rushed onto the field. And the Federal Reserve said, hey, this can't last. We can't have all of these people trying to buy so few homes. It's going to cause inflation to go up. So they raise interest rates to get people to stop wanting to buy for now. Well, what that did is it took everybody who was on the field that hadn't yet gotten a home, and they were off the field, but they haven't gone back into the stands. They are waiting on the sidelines, and they're waiting until rates go back down again, and they're going to rush the field again. And that's why, if you can afford the payment today, I believe you're far better off pulling the trigger and buying the home today instead of putting yourself in a position where you end up getting a lower rate later, but you pay more for the home and theoretically can't even get your offer accepted. All right, so let's move on and let's talk about the topic for today. So every month I do this first-time home buyer masterclass. Really, it isn't even first time, it's for all home buyers. And each month I cover a new topic, and then I finish out covering really a recap of the same thing I cover every month, which is the process of buying a home, what banks look for, how that process works, et cetera. Okay, so what we're looking at, and hold on one second here, get rid of that. Okay, so what we're going to look at today is we're going to look at closing costs. What are closing costs? Where do closing costs come from, and how do they work? So that's what I'm going to spend a good amount of time talking about today. So the first thing is I'm going to break down the closing costs using the loan estimate as my tool. In other words, the loan estimate, I'll talk more about in a few minutes, but the loan estimate is a document that you're going to get that is going to go over all of these fees. And so it's broken up into sections. So section A is the origination charges. And so section A, origination charges, those are fees. Points and discount points are the biggest piece of those fees. And the second part of it is lender fees. So this section A is controlled by your lender. It's actually the only section of all the closing costs that are different depending upon what lender you go to. Now, not the points and the discount points. I'll explain that in a moment, but the lender fees, the underwriting fees, the processing fees, the administration fees, those fees are determined by your lender. We charge about $1,750 for underwriting, processing, administration. That's what our cost of doing business is for my company. So we pass that along. That's our overhead for doing your loan. Now, points are a percentage of your loan amount. And points are really a fee that you pay to offset getting a lower interest rate. Now, what's the difference between a point and a discount point? It's technically a legal term. Some banks say, you know what, we're going to charge 1 point to everybody, but we're going to give everybody a starting rate that's a little bit lower. Other banks say, we're going to charge 0 points, and our starting rate is going to be a little bit higher. The math is exactly the same, because all it is a calculation to say, hey, the more I pay up front, the less I pay per month. So the more I pay in points, the lower my interest rate. The less I pay up front, the higher my monthly payment. The less I pay in points, the higher my interest rate. So it's a teeter-totter, and it really comes down to A, how much money you have in the bank to put towards the purchase. If you don't have the money to buy down the points, don't do it. B, how much monthly payment are you comfortable with and do you qualify for? Because if you're in a position where we're barely qualifying you, we may need to buy down or pay discount points to lower your interest rate. So that's what discount points do, is they lower your rates. Now, what its most important calculation, as long as you A, have the ability to pay the money and B, have the ability to afford the higher payment, then it's a choice. Now it comes down to betting on the future. It comes down to, should I pay points to get a lower monthly payment or a lower interest rate? So I'll give you some simple math. You're going to keep this loan, or it's not going to keep it. The key is not how long you're going to keep it. The key is, it's a 30-year loan. So most people say, gosh, if I can make back my money in 30 years, it's worth it. You're never going to keep this loan for 30 years. So you have to think, when you're thinking about fees and you're thinking about points, you have to say, what's my break even? How long does it take me to make up the money I spent up front? Now, if you're a math major or an economics major, you're going to say, John, your calculation's wrong because you're not taking into account the future value of money. No, I'm not. I'm simplifying the math. If you want to run that calculation, I can do it with you as well. But here's the simple example. If I said, pay me $100 extra in upfront fee, that would be the discount points, and I will save you $10 a month off of your monthly payments. That would be the lower interest rate that lowers your monthly payment. You would say, well, gosh, John, saving $10 a month just in the first year saves me $120. That's $20 more than what I spent. That's a good deal as long as you plan on keeping the loan more than that 10-month break-even point. Now, most people, you're not looking at that quick of a break-even point for paying discount points. Now, let me give you another end of the extreme. What if I said, pay me $100 and upfront, and I'll save you $1 a month? Now, somebody might say, well, gosh, that's still a good deal because in 30 years, I'm going to save $1 360 times. So sure, I'm going to triple my money, more than triple my money. You're never going to keep the loan for 30 years. What you have to look at is say, it's going to take me 100 payments. Okay, it's going to take me 100 payments, which is like 8+ years, 8 years and 4 months of saving $1 a month before you've made back the $100 you spent. The question is, are you going to keep this loan for 8 years? And that's all about interest rates and where they're going. Now, if you're convinced rates are going to 12 and never coming back, so you think we're at the bottom of where they're going to be, that's when you should buy down your interest rate. But if you think like I do, we're towards the top of where rates are, I think in the next year or two, we're going to see rates coming back down. Usually it makes sense to refinance if you can save at least 1% off of your interest rate. So do you think interest rates are going to be more than 1% lower in the next year or two? Then you have to look at that break-even point. I think we're going to see lower interest rates in the next couple of years. So if it's about saving money per month compared with the money you're spending up front, I don't think paying discount points is a good idea when we're at the higher end of the interest rate range. But the key to understand is sometimes I'm still going to recommend somebody pays points. Sometimes it's because the program you're using requires them. Sometimes it's because it's the only way I can qualify you, because your income only allows for you to qualify for a certain monthly payments. And so if you're higher than that monthly payment, you can't buy the house. So the only way to be able to buy it is to get an interest rate that's lower, and that's by paying discount points to get that lower interest rate. All right, so that's a basic idea of what Section A of the closing costs on the loan estimate are, and that is points or discount points, and then lender fees. Moving on, continuing talking about closing costs, the second section, or Section B, is what the federal government calls services you cannot shop for. So really, those are three major things. It is the appraisal fee, the credit report fee, and the flood certification fee. Why do they call it services you cannot shop for? Because the next category, services you can shop for, mean I'm not responsible for making sure the fees are 100% accurate. Everything in this section, I can't say oops down the road. I can't say, oh, I know I told you that the appraisal was going to be $500 and I printed that it was going to be $500, but the appraiser came back at the end and said it's going to be $600. Okay, I'm not allowed to change these fees unless there's something called a valid change in circumstances. So for example, if I sent the appraiser out and the appraiser calls up and says, hey, this house is a duplex. It's not a single family residence. It's a duplex and it's going to be more expensive because I have to do more extensive research. Then we have a valid reason to revise this fee. But aside from that, if we just made an oops and I under-disclosed or inaccurately disclosed the appraisal fee, I have to eat that because you can't shop for these fees. I am the provider. Doesn't mean I'm the one that's providing the service, but I'm choosing the company. We are choosing who the appraiser is. The appraisal fee you pay up front when you get your contract accepted. The appraisal fee runs between $500 and $800. And once the appraiser's gone out to the home, that's non-refundable. Now, a lot of people ask me, John, what about the rest of the inspections that I have to do? Can I wait to do the appraisal until I get the inspections done? The answer is usually no, because we don't have enough time. We have to do the shotgun approach because we typically only have 17 days sometimes at the outside, but usually closer to 10 days or less to make sure that the house appraises and that there's no issues with any inspections. So we've got to get them all done at the same time. Okay, so that's the appraisal fee. The credit report fee. So the credit report fee is basically the cost of pulling the credit report, and it's gone up significantly. Not only does it include the credit report fee, which right now is $47 for a single person and $77 for a married couple. So these fees used to be around $20 for a single person and $38 for a married couple. So they have more than doubled as of January of this year. And unfortunately, the three credit agencies, Equifax, Experian, and TransUnion, have a monopoly, a triopoly, and they all decided coincidentally at the same time to significantly increase their fees. And the federal government said, no big deal. So there's a much higher cost for credit reports now than there ever had been, and you don't have the choice to shop for that. So we have to know upfront how much your credit report fee is going to be, and often we're overestimating because on credit reports, we have to order updates. We have to double check at the end to make sure that you haven't gone out and charged up anything or opened up any new credit cards. We might have to update or order what's called a credit supplement that proves that some particular account that maybe you paid off that credit card already and the credit report didn't show it. So we have to go get an update for that. Well, we have to predict on average how many of those we need. And so we'll often estimate around $200 to $250 for credit report fees. Even though it might only be $77 in the end, what we have to estimate high enough because I cannot go a penny over this. If I go a penny over, I have to pay 100% of the cost. The third sample fee in this section of services you cannot shop for is the flood certification fee. So it's required. Some people say, John, by the way, it's pretty cheap. It's like $16. John, I'm not in a flood zone. Why do I need to pay that fee? So that we can prove you're not in a flood zone. Because if you are in a flood zone, you have to have flood insurance. So every property, and by the way, even if the prior owner wasn't in a flood zone, we have to prove that the flood zones haven't changed since the prior owner purchased the home. So flood certification fee, not very expensive, but it's something you cannot shop for. All right, services you can shop for. Now this one's kind of interesting because you can shop for title insurance, and basically title and escrow is a general term. So really the bucket for services you can shop for is really the title and escrow fees. By the way, before I go on too far, what you're not going to see on here is you're not going to see any of the fees for inspections that you hire through your appraiser. So that might be your home inspection, your roof inspection, pest inspection, septic inspection, any of those inspections about the property other than the appraisal. I don't control those. You don't pay for them through me. You pay for them through your realtor. And so you will not see any of those fees on the loan estimate. And we're not going to be talking about them tonight. So just be clear that those are fees that you have to pay. They're just not part of this breakdown in fees. But everything else that you're going to have to pay, it's included in this breakdown. All right. So we've got title insurance. What is title insurance? Title insurance is a fee. There's two types of title insurance. There's one that protects the lender and one that protects you, the owner or the buyer of the property. Now, what the heck does title insurance do? Title insurance protects us, the lender, and you, the owner, in case there's a problem down the road that says, hey, either you don't own this property because the person who sold it to you wasn't the rightful owner, or, hey, there's a debt that the prior owner had on the property that nobody knew about. And legally, that person's owed their money. And you're now the owner of the property. So, you know that whole finders, keepers, losers, weepers thing we talked about as a kid? That doesn't exist in home ownership. That doesn't exist in the legal world. Even though possession is 9/10 of the law, in this case, it's not. So you own the home. You've lived there for years. Somebody comes back with a valid piece of paper that says, hey, the prior owner owed me money and he gave me a security interest. He gave me a deed on this property. I want the property or I want my money. They have a legal right to the property because they can foreclose on it or the money that they're owed, and you're the holder of the home. So now what happens? You lose your house because you didn't know that this guy was owed money, this person was owing money to somebody else? That's where title insurance steps in. So it's a one-time fee for insurance, and owner's title insurance is optional. You don't have to have title insurance, but I strongly recommend it because owner's title insurance protects you just like the lender's title insurance protects us. Now, the lender's title insurance is only good for that loan. So if you refinance, you have to pay for another lender's insurance policy. And unfortunately, the title company won't transfer the insurance policy from one loan to the next. And therefore, every lender, every loan needs a new lender's policy, but you only have to buy one owner's policy. Because once you're the owner of the property, if you refinance, you're still the owner of the property. That owner's policy covers you for as long as you own the property. Okay. So the title company has fees that they're going to charge. They're going to have courier fees. They're going to have notary fees, doc preparation fees. They've added some extra fees, like there's a what's commonly referred to as a loan tie-in fee. Well, what they kind of did is kind of like what airlines have done. And airlines have said, hey, we just used to charge a fee to fly you from San Francisco to Hawaii, but we realized that we can change the rules. And we can tell you that, hey, I know that fee used to include 2 bags for free, but well, now it doesn't include 2 bags for free. It includes 1 bag for free. And then later they change the rules and say it includes no bags for free. You have to pay extra for bags. And so the title insurance industry as a whole has said, well, we just used to charge for the escrow fee for just doing the escrow. And I'll explain the escrow process in a moment. But then they realized, well, wait a second. We do more work when there's a loan than we do when it's a cash purchase. And so instead of saying, hey, we'll give the cash people a lower price, they said, let's charge the people who are doing a loan a fee to tie the loan into the escrow. And so we're going to charge $400, about the average loan tie-in fee, to the buyer because, well, you're doing a loan. And if you weren't doing a loan, we wouldn't charge you that fee, but we have extra paperwork that we have to handle. I'm not sure I agree with the reason why they have to charge it, but the fact is, I don't agree why they have to charge me for bags when they used to fly my bags to Hawaii for free. So bottom line is, they're the ones that are providing the service. They're the ones that get to decide. We're the ones buying the service, and we get to decide if we want to use them or not. That kind of goes to the whole services you can shop for. And I'll explain in a minute, but you actually have a choice of what title company and escrow company you use. Before I go to there, I'm going to explain to you what the escrow process is. It's also called the settlement process. So the escrow or settlement fee is a fee that you pay for the escrow company to do the escrow or settlement services. Now, what is that, John? What the heck is escrow? It is the neutral third party that makes sure everybody has what they need before they get what before they give what they're giving. And so think about when we were kids, and maybe you had, I don't care, you could have had baseball cards, you could have had a rock collection, you could have had whatever, and you want to trade it, one of your things with your friend. And so you'd say, hey, I'll tell you what, I'll give you my Mickey Mantle rookie card for your Babe Ruth rookie card. And your friend says, okay, I'll do it. And so you hand over your Mickey Mantle card before they give you the Babe Ruth card. They're going to run away with it. They will. Not sure. Hopefully they're not, but some people will. So you've got to be a little worried about that. And so you say, fine, give me your Babe Ruth, and then I'll give you my Mickey Mantle. But they're afraid you're going to run away. You're going to take their card and run away. And so what do? You go find a teacher. And you say, hey, teacher, we're going to trade these two. So if I give you my Babe Ruth and he gives you his Mickey Mantle, you have both. You're a neutral third party. And you say, yep, I have both. Here you go. And you will give it to the other person. Will you do that for us? And the teacher will make sure that everybody has what they expected to get. That's what the escrow process is. So essentially, the escrow officer says, okay, what does the seller want? The seller wants $500,000 for the sale of their home. Now, what does the bank want that currently is owed the money on the home? They want their money back. So I've got to give the seller their money, but only after I've paid the bank their money. What does the buyer want? Well, the buyer wants the ownership of the home. So they want the deed signed over to them. And they want to know that all of the debts on the home are paid off, that nothing is owed to anybody. And so there's no way they can get the money from the buyer and the deed from the seller at the exact same moment. So the title company, the escrow actually, I should say, is doing that at different times. They're collecting the upfront deposit from you. They're collecting the remaining down payment from you. They're collecting the loan amount from me. Then they're getting the seller to sign over ownership. They're making sure everything looks good, and then they trade. So that's their job. Now, in different areas of the country and even different areas of the state of California, this is handled different. Often it's one company that does title and escrow, especially in Northern California. Now, in Southern California, it's usually two companies. You've got the title company and the escrow company. In other states, they actually use, instead of an escrow company, they use attorneys. So if you hear of attorney fees or going to the attorney's office to sign, the attorney is essentially the same as the escrow company providing that service. So these are services you can shop for. Now, I got to tell you, most buyers aren't shopping for these services. Usually it's your real estate agent who's choosing what escrow and title company you are using. And usually it's a negotiation between the buyer's side and the seller's side. So when you write your offer, you're writing your offer and your realtor is writing on the offer as the buyer, we want this title and escrow company. So it's the buyer's choice. The realtor rarely asks the buyer, but you do have a choice. So if you want to be involved in that decision, tell your realtor, hey, I'd like to help decide who is the right title company and escrow company we should be using. Once you write that offer, now the seller has the right to negotiate. And they can negotiate anything. They can negotiate fees, they can negotiate terms, they can negotiate price, and they can negotiate what company is doing title and escrow. So you can say, I want ABC company. The seller responds and says, hey, I'll accept your offer as long as we use XYZ company. Now you can refuse, but the seller can refuse to sell to you. So it's really about the negotiation. When push comes to shove, it really doesn't matter. So I say go with who your realtor recommends. And if the other side negotiates out to a different company, it's not a big deal. Sometimes it's going to cost you a little bit more, but that may be why they negotiated that way, because the seller ends up paying less when you pay more. So you just got to be aware it's all part of the negotiation. All right. Now, aren't we having fun? Let's talk more about fees. Section E is taxes and other government fees. So you're paying a recording fee. That's the fee the government charges to record the deed, making you the owner of the home, and transfer taxes. Transfer taxes are typically county taxes that are paid as a percentage of the sale price, and it is paid to the county, and the purchase contract determines who pays it, whether it's the buyer or the seller. But be aware, there's some cities that charge transfer taxes as well. And in some cases, the city transfer taxes can be really expensive. I had a property I closed escrow on for a client, helped close escrow on a property in Los Angeles last month. And the city that person was buying in, the county of Los Angeles had a transfer tax that was about $1,000, but the city had a transfer tax that was $6,000. Okay, this was $1 million property, but it was still $6,000. And so the buyer was surprised that they had to get hit with an extra $6,000 in fee because the seller negotiated the buyer needs to pay the transfer tax. The buyer thought there was only a county transfer tax, and they didn't realize until they were in escrow, there's also a city transfer tax. So you want to pay attention to that. And again, these fees all fall to the bottom line depending upon how it's negotiated in the contract. All right. The next thing you have is prepaid expenses. So prepaid expenses are really three things. It's interest, insurance, and property taxes. So whenever you buy a home, you must have homeowners insurance. Even if you're paying the homeowners insurance and taxes on your own, you still have to prepay the first year of homeowners insurance because the bank mandates that we know that you have at least a year's worth of coverage. Now, if you're paying your property taxes as part of your monthly payment, I'll show you in a minute, you have to put a cushion in the account as well for additional insurance. But if you're not including it in your payment, you don't have to pay that cushion, but you always have to pay the first year. And I don't want you paying it ahead of time. You can write a check to the insurance agency, but now I have to prove that the check is cleared. I have to prove that the insurance company shows that you don't have any balance due. Instead, just include it with your closing cost check, and the title company, as part of the escrow process, writes a check to the insurance company to pay for the first year's insurance. Okay, so that's insurance. The second part of prepaid expenses is interest. So you pay interest from the day you become the homeowner until the end of that month. And that's because we bill you in 1 month increments, and you don't pay for the first half partial month. We can't bill you for a partial month. So if you closed escrow today, you would prepay for 6 days of interest, May 25th through May 31st. You'd make no payment on June 1st because the interest for May had been prepaid. You'd pay on July 1st, paying the interest for the month of June. If you closed escrow next Thursday, June 1st, you would prepay for 29 days of interest. So your fees went up, but you got to skip the July 1st payment because you prepaid June's interest. You have nothing due on July 1st. Your first payment is August 1st. Many people try and time this and say, oh, you should always close at the end of the month because it's cheaper. But that just makes your next payment come that much faster. You're not saving money and it's not costing you any money either way. You're simply paying for every day you've owned the home. It's just a question of whether you pay it up front and skip an extra month, or you pay a little bit up front and you pay your first monthly payment sooner. The last thing you have to pay for is your property tax prorations. So the seller of the home has likely either received a bill that hasn't been paid or received a bill and paid it for your property taxes. And it's rare that each property tax bill in California is for a 6-month time frame, from July 1st to December 31st, and then from January 1st to June 30th. So unless you're closing escrow on December 31st or June 30th, there's somebody who paid a bill for that 6-month time frame, and the other party is living in the home during that time. So you either have to, if the seller paid the bill, you have to pay the seller some of the property taxes. If you're paying the whole bill, the seller has to credit you some money because you're going to be responsible for the entire bill. So these are what we call prepaid expenses. This area moves up and down throughout even during escrow. These numbers will be modified because we don't know exactly when we're closing escrow. We don't know at the beginning of the escrow period when you went into contract. We're not sure if the seller's paid the property taxes or not. We're not sure if you're going to have to write the check or not down the road. So these things are estimated and they get finalized through the escrow period. All right. The next thing we have is the initial escrow payment. So you've got to pay a cushion for future payments of property taxes and homeowners insurance. So that cushion is usually 2 months plus the number of months between now and when the next bill is due, minus the number of payments we're going to receive. So the simplest thing is that it's anywhere from 2 to 6 months of a cushion. I'm not going to go through the exact calculation of it, but it's a cushion to make sure we have enough money in the account to write the check the next time the payment is due. And I'll simplify it, but I'll explain it this way. If you bought a home, you went to escrow today, you closed escrow on June 25th. Your first payment is August 1st, but your property taxes are going to be due on November 15th. So we're going to receive the August, September, October, and November payments. So we will only have 4 payments from you before we have to write a check for 6 months worth of property taxes in November. So we have to collect the 2 months that are missing so that we have enough to pay the 6 months of taxes plus 2 months of a cushion. So we're going to collect 4 months of property taxes from you up front. So that's really the overly simplified but accurate reason or calculation of how much you pay. Okay, so that's it for what the total costs are. I know that was a lot. We'll break down what the total, what you're looking at as a grand total in a few minutes when I go through the stuff I cover every month. But what I want to finish with is a couple of things. First of all, when do you review these? The first time you review them is at pre-approval. You should get a worksheet, or I send my clients a total cost estimate, which is a web page that's built out that shows all of your costs and compares multiple scenarios against each other. Now, at that moment, we're ballparking a lot of things. We're also assuming what is customary for what's called the splits. One of the most confusing things I get asked from buyers is, hey, John, I'm in contract and we're talking about closing costs. And my realtor told me that we're splitting the fees 50-50 between me and the seller. Well, yeah, there are fees on the contract that say who pays this, buyer, seller, or both. But really, that's only a few fees. It's the escrow fee, it's the owner's title insurance fee, and it's the transfer taxes. Those are the 3 biggest ones. And then maybe there's a home warranty that one or the other is paying for. But the truth is, most clients walk over to me or come sit down with me and say, hey, John, oh yeah, you say it's $15,000 in closing costs. Well, the seller's paying half of that. So I'm only paying $7,500. No, as a matter of fact, the estimate that I gave you in the beginning already assumed the seller was going to pay half of those because that's customary for our county. That's typical for, like, for example, in the Central Valley and the Northern California Central Valley, it is customary for the buyer and seller to split the escrow fee and the owner's title insurance, and it's customary for the seller to pay the transfer taxes. But that doesn't mean it has to be that way. If you're in a very competitive situation, you might say, you know what? I'm not only going to offer a great price, I'm going to give great terms. And this is one of the ways you can win in a highly competitive situation is by saying, I'll pay all the title and escrow fees. So it makes the offer that much better, not just in the price of what the seller is getting, but in the terms of what they're getting. Because offering a higher price is sometimes counterproductive because sellers know your house has to appraise for that higher price. So the people who offer higher and higher and higher prices sometimes don't win simply because the seller and the listing agent don't believe the house will appraise for that price. But you can get the better terms to the seller by you paying all the title and escrow fees. The converse is true also. If you are in a situation where the house has been sitting for a long time, you might say, you know what, I'm going to offer them full price, but I'm going to have them pay all of the fees and I'm going to ask for a seller credit so that I don't have any closing costs. And the seller still feels like they won because they got their full price, but you won because you got them to pay a lot of fees that actually saved you more than lowering the purchase price a little bit. So things to think about when you're talking with your realtor. Now, once you get into contract, you're going to get a document called a loan estimate, and that has to be given to you within 3 days of the lender receiving the contract. So that will break down these fees. That solidifies the services you cannot shop for. We have to have designated them by that time. And then you're going to see the same fees all over again, but a more accurate version, not a final version, but a more accurate version on a document called the closing disclosure. Now, legally, that has to be given to you at least 3 days prior to you signing loan documents. So you'll see that. You'll have 3 days to review it. If there's something that you don't think is accurate, you still want to acknowledge receipt. Signing the loan or the closing disclosure doesn't mean you agree to those final numbers. It means you're signing to show that you've seen it, and it starts the 3-day clock. Okay, so the closing disclosure has to be seen before and acknowledged, and then the 3-day clock starts before you can sign your final loan documents. Okay, so this is the end of the section of new information that I cover, different stuff every single month. Now I'm going to go on to what I cover every month, and that is the process of home buying and how it all works. So I'm going to start with what are the things that the banks look for. They're simple. 3 things we want. We want to know that you have the cash, which is down payment and closing costs and sometimes reserves. We want to know you have good enough credits, because how well you paid your bills in the past is the best indicator of how well you'll pay them in the future. And we want to know that you have enough income, because no matter how good your credit is, if you don't have enough income to write a check to cover the payments, you're never going to stay on track with your bills. Okay. So as we look at this, there is a 4th thing that we care about, which is the property. And we look at the value of the property. It's got to be worth what you're paying for it. The condition of the property. And don't misunderstand, the appraiser does not do a home inspection. The appraiser is going out and the appraiser is looking at, is there any health or safety hazards in the home? And is there anything, they're measuring the home, they're taking pictures to make sure it is what we think it is, but they're not testing it. So they're making sure electricity works by turning on a light. They're making sure the water works by turning on a sink. They turn it to hot and they wait for it to turn hot, and that proves that the gas works because the hot water heater got hot if it's a gas water heater. Okay, so they're doing just random sampling. They're not checking every light switch. They're making sure the stove works by turning on one burner, not turning on all of them. So condition of the property. No, and by the way, this is really, really important. There is no such thing as is to a lender. A lot of buyers and even realtors will say, oh, John, this property's as is, so the condition doesn't matter. No, as is on a purchase contract is a negotiation between the buyer and the seller saying, hey, I'm selling this as is. I'm not doing any work on it. You're agreeing to buy it in its current condition. That doesn't mean the bank's agreeing to lend on it in its current condition. So the bank can say no. The bank will do an appraisal, and that appraisal will come back and say, hey, there's some issues with this property that don't meet minimum property standards. So these have to be remedied before we can close escrow. And you can't turn around and say, no, John, don't worry. This was an as-is property, so we don't have to fix those. Yes, you do. If it's a health or safety issue or a livability issue that was brought up by the appraiser, they must be fixed. Okay. The 3rd thing about the property is the type of property. Not all properties work the same way. As a matter of fact, lately with housing prices going the way they're going, I've gotten a lot of people saying, hey, John, I understand you do manufactured homes. I've got this house in a park where I rent the space and I want to write an offer on it. Well, guess what? That is not real estate. That's a manufactured home, but it's basically more like a motorhome than it is a home because it was on wheels. Whether it's been taken off the wheels or not, it is, you don't own the land. It's not permanently attached to the land and recorded as a piece of that land with the title company or with the county recorder's office. So tomorrow night it can be picked up and moved to another lot somewhere else. So that is not considered real estate. Duplexes, triplexes, and fourplexes are a different level of risk and different down payment requirements than a single family home. Condominiums and townhouses are viewed differently. So just be aware that if you're approved, we're typically approving you for a single family home. If you're looking for anything else, you're going to want to talk to me and make sure I'm aware of that. Or if you change your target of what you're looking for, you say, I'm not looking for single family homes anymore. I'm looking for condos. I'm looking for duplexes. You need to let me know because it can and often will change the terms of your pre-approval. All right. So how much money do you need to close on a home? You need 2 things. You need down payment and you need closing costs. Now, we just spent a lot of time at the beginning of this masterclass talking about all of the different closing costs. Here's the truth. That those added together add up to around 3% of the purchase price, and on average, somewhere between 10 and 15 grand. Now, if you're buying $1 million home, it's not 3%. It's not going to be 30 grand. If you're buying a $100,000 home, it's not 3%. It's not 3 grand. It's really 10 to 15 grand with a little bit of wiggle room at the bottom end and a little bit of wiggle room at the high end. So if you're buying a $600,000 or $700,000 home, it might be upwards of $15,000 to $18,000. But a lot of the fees are the same dollar amount, regardless of how expensive the home is. The appraiser is going to charge about $500 to $600, whether it's a $100,000 home or a $500,000 home. The underwriter is going to charge, we're going to charge the same money for the underwriting fee, whether it's a $100,000 home or $1 million home. So you have to be careful about percentages, but you also can't just say, oh yeah, closing costs are an exact dollar amount, because some fees do slide or change specifically based on the purchase price. So it's kind of a combination or an average of the percentage around 3% and around $10,000 to $15,000. Your down payment can come from one of three places: your own funds, gift, or from a down payment assistance program. Your closing costs can come from the same three places, but you also can pay for closing costs from a seller credits or a lender credits. Now, seller credits, we talked about a little bit earlier. That's you saying, hey, Mr. Seller, I'll give you X number of dollars for your house, but I want you to pay $10,000 towards closing costs. If nobody else is offering on the home, there's a good chance you'll get that. If a lot of other people are offering on the home, there's almost no chance you're going to get that. Now, a lender credit, that is you paying a higher interest rate. So kind of like points, when we talked about those earlier, you're paying a higher interest rate, and we are decreasing your points so that we are crediting you or lowering your fees. So you've heard the term buy down your interest rate. You pay fees to lower your rate. Well, a lender credit is really buying up your interest rate. You take a higher interest rate and you get lower fees. The problem is rates are so high right now that lenders are not willing to take a higher rate and pay fees on your behalf, because the higher the rate we give you, the more likely you're going to refinance very, very soon. So it is not possible right now in this market, a high interest rate environment. It's very, very hard to get a lender credit. Okay. Now, down payment assistance programs, there are so many different programs out there. As a matter of fact, there is a brand new program that just came out this week that we launched that is a 1% down payment conventional loan with zero mortgage insurance. It is super, super exciting. Now, there's some rules to it. You got to make under a certain limit of income. You've got to buy a home no more than $350,000. But if you meet those criteria, it's an amazing program. If you don't, there's other programs. There's special grant programs for medical and healthcare workers, law enforcement, firefighters, education, people who are educators, including staff members of the schools. And there's a special grant program for people who are employees of the California counties that are listed on the screen. So there's lots of different ways to help you with down payment and to help you with closing costs. There's even a program right now that can provide up to $10,000 as a grant, provided that you are a first-time homebuyer, you're under a certain income limit, that you don't have you have no more than $20,000 left over after you purchase a home. You have to be using a realtor, a California Association of Realtors registered realtor, and you have to be a member of one of three underserved categories that were determined by the California Association of Realtors. Those three categories are a person of color, a person with a disability, or a person that is a member of the LGBTQ plus community. So if you meet one of those three underserved communities and the other criteria, there's money right now to give you a $10,000 grant towards your closing costs. So there's lots of ways that we can help you out, and I'm an expert in all of those different ways. So let's talk about, yes, Alonzo, the HIF grant. I agree completely. So here's a program, here's an idea of the different types of loan programs. So what we've got is conventional, that's Fannie Mae and Freddie Mac. And then the next category is the government-backed loans, which are FHA, VA, and USDA. And the third category is jumbo loans. So I'm going to go through these and give you kind of a rough idea of how they work. So a conventional loan is your Fannie Mae, Freddie Mac, your normal meat and potatoes loan. The difference between Fannie Mae and Freddie Mac is next to nothing. It's like the difference between Coke and Pepsi. You don't care, you shouldn't care. It's just a conventional loan. Now, you can put as little as 3% down, but you're going to get the best terms if you're putting 10% down or better. You can have a credit score as low as 620, but you're going to get the best terms if you have a credit score of 740 or better. And your debt ratio can be as high as 50, but you're typically looking to be somewhere between 28 to 36% is ideal. If you don't meet those criteria, then you would want to go with a government-backed loan. That's FHA, VA, or USDA. Now, they have loan limits that are different for each of those programs. USDA has rules on specific geographic areas. I actually have a webinar I did on USDA that I have on my YouTube channel that you can check out. And these programs require anywhere from 0 to 3.5% down. And they are looking ideally for a 640 or better credit score. And sometimes we can go as low as 580. And they'll be more forgiving on your debt to income ratio, sometimes as high as 55%, but ideally more like 33 to 45. The jumbo loans are all other types of loans. And they are loans that exceed the conventional loan limits, or loans that maybe they're normal size loans, but maybe you have some issues with your credit. And so we have to get a loan that is not conventional or government backed. So I'm going to rewrite this slide. I'm not going to call it jumbo anymore. It's really non-conforming. And so it's not only for large size loans, but for loans that don't meet the other criteria. But specifically for jumbo loans that exceed the conventional limits, we're looking at loans that you really need 20% down or better with a 740 or better credit score and a really low debt to income ratio. So let's talk about the home buying process. It is right now a very, very difficult time to go to from a regulatory perspective. We're dealing with inflation, we're dealing with high regulation, we're dealing with the economy in flux. And so who you use to do your mortgage matters now more than ever, because really this is like flying in an airplane. It's about getting to your destination, understanding there's going to be turbulence. Because if you've flown in an airplane, you know that you hit turbulence pretty regularly, and it's not the sign of a bad pilot. Hitting turbulence simply means that, look, that's part of the process. Just like when you're buying a home, your realtor and your lender are going to work on your side to make sure that you hit as little turbulence as possible and that we tell you about it ahead of time. But the fact is, your pilot's most important job is to make sure you don't crash and to make sure that they didn't just serve you a hot coffee right before we hit turbulence. Well, that's the same thing with your lender and your realtor. It's our job to minimize the turbulence, but sometimes we don't have a choice. We just have to fly right through it. So let's talk about the actual process. The first thing is getting pre-qualified or pre-approved. You always want to do that before you start searching for a home, because you don't want to get your heart set on a home and then find out you don't qualify. Once you find out you're qualified, start searching for your home. Just recognize you cannot lock your interest rate until you get an offer accepted on a home. Now, there are some programs. I have programs that we can actually lock your interest rate while you're shopping, but you're paying an upfront fee and you only have 60 to 90 days to find a home and close escrow. So you better be determined to find a home quickly and do whatever it takes to get into escrow. Otherwise, you forfeit the upfront fee that you paid. So locking up front, by the way, the benefit is if you lock up front and rates drop, you can get the lower interest rate if they drop. And if rates go up, you don't have to worry about the higher interest rate if they go up. But if you don't close within that 60 or 90 days of when you locked, you forfeited the upfront fee. With the volatility we're seeing right now, it's an insurance policy that some people are finding valuable. For the most part, I don't find it to be a good idea, especially because inventory is so low. The number of homes that are for sale is so small that it's hard to find a home within that quick of a period of time. And you run the risk of forfeiting that upfront fee before you were able to close escrow. Once you do find a home, we lock your interest rate, and that's when processing and underwriting happens. We re-verify everything we ask for up front. You're going to say, wait, John, I already gave you all that stuff. Yes. And we now need to check and see if anything's changed. So we're going to re-pull your credit. We're going to ask for your income documents again. We're going to ask for your pay stubs and bank statements and W-2s all over again. So be prepared for that. But once we get through that process, we get the appraisal done, then you have final approval and you get to step 5 of signing your documents. At that time is when you bring the rest of your money in. So whatever money that I had said in the beginning you were going to need, you get that on the loan estimate, you get an update at the closing disclosure, and then you bring that money in when you sign documents. And typically 1 to 3 days later, you get your keys and you get to move into a home. So super, super exciting. Step 6 is my favorite spot when we get to celebrate and get you into a brand new home. All right, couple of things before I wrap up and get to any questions anybody has. First of all, when it comes to the financial benefits of owning a home, I think it's really important for people to understand what the benefits are of owning a home. Because when you're a homeowner, you are paying often more than what you were paying in rent. And a lot of people think that, well, I can't afford to pay that much more. But the truth is, you've got 3 major benefits as a homeowner that you didn't have as a renter. The first is a tax write-off. Now, got to talk to your tax advisor because the tax write-off is different for everybody depending upon lots of factors. But as an example here, for a $350,000 home where you put 10% down, you'd be looking at around $590 a month that you're saving in your tax write-off. Then you're looking at what's called a forced savings account. So the forced savings account essentially is saying, hey, when you make your mortgage payment, $300 of that mortgage payment is actually going to your pocket in the form of paying down your balance and is increasing the equity you're going to have in your home when you sell it later. So you're building savings down the road every single month by putting that money towards your equity. When you're renting, none of the money you pay in rent is set aside for you later. But as a homeowner, there's a portion of your payment that goes towards principal. That's your money later when you sell the home. So that's a huge amount of money. In this scenario, it comes out to around $300 a month. And then finally, you have appreciation. Now, appreciation is a thing that a lot of people focus on to say, hey, John, home ownership's a bad idea because house prices aren't going up. Well, first of all, appreciation, it's the big, actually, it's not the biggest. It's not even as big as your tax write-off, but it's maybe a third of the money that you're saving is through appreciation. But even in a small appreciating market where maybe you're only going up 2% per year, by the way, the average across the country is 3% per year, but some years are higher and some are lower. The average in California is 5 to 6% per year. So a 2% appreciation is a low number. You would grow the value of your home by $7,000 in the first year. Divide that out by 12, and that's $583 a month. So on a $350,000 home, you're really getting about $1,475 in wealth building every single month. All right. So when you talk about monthly payments, one of the best ways to look up a monthly payment is to use my app and use the calculator. So if you don't have my app already, scan this QR code, install the app. There'll be a button on the bottom for calculator. You click on there, you click on new purchase. The only thing you have to do is to double check the interest rates. We adjust it about once a month, but it's never accurate for where your loan is, what you're qualified for. So you should know from me a ballpark interest rate that you should be using. Just adjust that rate every time. But now you can adjust your down payment amount. You can adjust your purchase price. But remember, the calculator does not include closing costs. So you've got to add that 3% or $10,000 to $15,000 for closing costs. You've got to add to what the calculator tells you your total cash is that you need to purchase the home. All right, let's talk one last thing really quick before I wrap up. If you have any questions, by the way, if you're watching through my live stream on social media, feel free to put comments on there. If you're watching via Zoom, you can put your questions and comments on Zoom. Right now, it's really, really important who you use for your financing. And there's 5 simple reasons why. First of all, the reputation of your lender. There are lenders that have poor reputations. There's lenders that are either only internet-based and they have no face in the community, so they have nothing to lose if they tell a lie. So having a lender that has a great reputation is critical to you. Thanks, Raina. It absolutely is critical. Okay, the second thing is, what does your lender do before the offer is accepted? So I am calling the listing agent, I'm emailing, texting the listing agent, I'm explaining to them how well qualified you are, and I'm helping to answer their questions proactively. Because if you're in a multiple offer situation and other people are writing offers similar in price to yours, the fact is, if your lender has a good reputation and is communicated proactively, that can make the world of difference in the real estate agent's recommendation to their seller on which offer they're going to accept. The third thing is credit and income fully underwritten. If we need to fully underwrite your loan, we will. We have the opportunity to do that. That gives you that much more strength to move faster if you're in a highly competitive situation. The fourth thing is we can help you look at what contingencies you can remove. That's a slippery slope. I'm not a huge proponent of that, but the truth is in 2020 and 2021, it was the only way to get an offer accepted. And so if we end up getting in that position where you're highly competitive situation with another buyer, being able to remove contingencies is critical. And the final thing is how quickly we can close escrow. We can close escrow in as little as 15 days on most transactions, which will help make sure that you can get your offer accepted when you're in a highly, highly competitive situation. All right, so we're going to wrap up. So I'm going to talk about next steps. If you want to move forward, then definitely scan the QR code and start the application process. But more importantly is stay in communication with me. The best way to do that is through my YouTube channel. I live stream a lot of these to YouTube. I do a weekly update every single Friday. That's a market update. I do a financial Friday. Tomorrow, I'm talking about secrets to buying a home as a self-employed person, and how you get around some of the issues that come up because you maybe write off too many things on your taxes. And how do you buy a home when you don't want to show a lot of income on your taxes? So this really helps you to be able to understand the home buying process, because I've got a huge library of videos that can help you, just like this one here that's going to be on there as well. So really my goal is to help you through the home buying journey. So at this point, I don't see any questions specifically. So I'll wrap up and just say, if you have questions, post them right now. Otherwise, I look forward to taking great care of you. I'm honored that you put your trust in me, whether you're ready to buy now or you're ready to buy later. Alonzo, I'll get to your question in a second. Just know that I plan on being in this industry for a long time. I've been doing this for 22 years. I'll be here for at least another 22. So if you're not ready today, that's okay. I still want to sit down with you and give you a game plan to help you get approved down the road. All right. So Alonzo, good to know about the income statements and bank statements. Yes. Well, I talk about the grant question, and absolutely, guys, there are so many questions that we can't answer in these seminars. And so I just want to make it clear, reach out to me directly. Alonzo emailed me a question he had about a program. There are more programs out there than I can cover in my videos. So just know that I have knowledge and access to a majority of them. And if I don't, I'll look into it and find out. But I just want to really make sure that you're clear. My role right now is interviewing to be your lender. So if you are unsure who you want to use to buy a house, I am interviewing for that process. I want to be your lender. I want to work with your realtor. And if you don't have a realtor yet, I want to help connect you to an amazing realtor. So ladies and gentlemen, I appreciate you listening in tonight. I hope you've learned something, and let me know what else I can do for you. And I hope everybody has a wonderful day. We'll talk to y'all soon, and good night. Bye-bye.